Bollinger Bands are often a misunderstood technical tool. Many traders think that these bands give buy or sell signals. However, Bollinger Bands do not trigger trading signals, but they do provide you with information and answers to questions. Bollinger Bands inform the trader of whether or not the prices are high or low on a relative basis. Prices are low at the lower band and high at the higher band. This information can serve as the basis for many trading approaches. Bollinger Bands are intended to be a part of a larger trading approach and are not intended to be used for trading by themselves. Bollinger Band components. There are three main components of Bollinger Bands. The middle band. This is a 20-period moving average line. This line splits the difference between the upper band and the lower band. The upper band. This band is 2 standard deviations above the middle band. The lower band. This band is 2 standard deviations below the middle band. The standard deviations up and down show us how far away from the average the price is. Finding the trend using Bollinger Bands. As you observe the price action on a chart with Bollinger Bands, you will notice an oscillation from upper band to lower band, and from lower band to upper band, back and forth, back and forth. This oscillation is typically favoring one direction or the other. In an uptrend, the price will leave the lower band, touch the upper band, and then return back to the lower band. If the price is touching the lower Bollinger Band, you can reference the most recent touch of the lower band. If the price is currently higher than it was the last time it touched the bottom Bollinger Band, or the lower band, then you are in an uptrend. Downtrends work exactly like this, but are opposite. You will see the price leave the upper band to touch the lower band, then it will return to the upper band. At the point of return to the upper band, if the price is lower than the previous touch of the upper band, you are in a downtrend. You can combine this with oscillators such as stochastics in order to better time your entries and make them in the direction of the trend. Price containment. When you observe a price chart that includes Bollinger Bands, it should be evident that the price is most typically contained within the area between the upper band and the lower band. On occasion, volatility can cause a candle to break this norm. When this happens, it creates an opportunity for trading. Pay close attention to the price action whenever part of the candle body exposes itself to the areas either outside of the upper Bollinger Band or outside of the bottom Bollinger Band. This type of price movement typically will lead to the creation of wicks as the price reverts within the bands. Occasionally, an entire candle will form outside of the bands. Pay very close attention to these, as it is most common for the price to aggressively attempt to revert into the space between the bands once again. If an entire candle is found outside of the Bollinger Bands, these opportunities can most commonly be taken advantage of using smaller time frames to perfect the entry. Hey, if you like this quick, no BS approach to Bollinger Bands, please consider subscribing to the channel, give the video a like, and share this with your friends.